Hi, welcome to Money Masterclass on Money9 TV9 Network's multilingual personal finance news service. I'm Karthik Malhotra. Well, over the last few weeks, we've been seeing a lot of stories around Indians investing in US stocks, US equity markets. And that's a trend that we've been following here at Money9. Counterintuitively, in fact, the stocks that were in the news were the FANG stocks of Facebook, Apple, Amazon, Netflix, Google. But there's a new report that Winvesta has just launched, which states that these stocks, the FANG stocks, make only 17% of the total investments Indians are making in the US. So, which are the other stocks, and is it the right time and the right moment for you as an investor to go ahead and park some money in the US stock markets as an investment? What returns should you expect? And what are the costs involved in making these investments and finally seeking the profits back? Joining me to understand the trends as well as the costs is Swastik Nigam, CEO and founder of Winvesta. Hi Swastik, thank you so much for joining us on Money9. Take us through the key findings of your report. Which are the stocks, if not the FANG stocks, that people from India are investing in?
Sure. Thank you very much, Karthik. It's a pleasure being here. You're quite right. We were expecting that the FANG stocks would be the most popular stocks. And however, we were pleasantly surprised that when we started noticing where people are investing, they're going significantly beyond the FANG stocks, right? So Tesla, for example, is the most popular investment. Along with that, you find a lot of other electric mobility. You have NIO, which is a Chinese manufacturer, for example, right? You've got another theme which props up, which is Riot, which is a Bitcoin mining and it's a blockchain company in effect. All of these trends, exactly as you mentioned, they've got no, you could say, consumer presence here in India, yet they have become extremely popular. Another one, for example, is Nikola, which is another electric mobility company. And the FANG stocks are clearly, they are there in the top 10, but are clearly being relegated to the bottom half of that top 10. These were, I'd say, interesting, surprising, but at the same time, it sort of tells you that India is sort of seeing a lot more of what's happening in the West, whether it's this absolute bull market that electric vehicles have so on seen. And we are seeing that by virtue of these becoming the most popular, the best performing stocks in recent times. But of course, there's a lot of conversation about it being in bubble territory as well. Yeah.
So, interesting trend there, and also counterintuitively, if I may, people are looking at investing in stocks directly and not going through the ETF route. Whereas in India, I think the average investor is still more comfortable investing through mutual funds and SIPs. So, what is the figure over there, and how does that work for the same person who's looking at domestic and international markets, but in two very different ways?
Yeah, I think that's a good question. So I'll take that in two parts. Firstly, I think people just are able to understand individual stocks a little bit more easily in the West than the whole wide variety of funds that do exist, right? Remember, this is a very young trend. People in India are just about discovering investing overseas. However, we are seeing clearly that asset growth in ETFs in the US also is increasing, right? The number of ETFs that people are investing in are increasing. It goes beyond the Nasdaq 100 or the S&P 500, which is the triple Q and the SPY respectively. You've got the ARC funds, which is the managed by Cathy Wood, the ARC Genomics and the ARC Innovation ETF, which are other two popular funds as well. And the VTI is the Vanguard Total Index Fund. So we are seeing that this is increasing. But of course, you need to do a little bit more discovery, because when you're investing in funds in these particular ETFs, you're investing in a particular asset allocation strategy in effect. So, hey, I want a geographic exposure. I want a sector exposure, say fintech or biotech or genomics or so on, right? Semiconductor, lithium batteries. So you see that these are all different parts and needs a little bit more discovery. Whereas individual stocks, one, are far more in the news. They are far more deeply covered, whether it is by other people who are giving their advice, recommendations on it, or what people are asking their friends, colleagues, and so on to be tracking as well.
Right. So, as somebody who is enabling these transactions, what do you suggest? I understand you may not be a financial advisor, or I'm not expecting you to pick stocks. But what would you advise people to do? Is direct stock picking a great idea, or is it safer for people to diversify and have a bucket of stocks through an ETF or a mutual fund sort of a vehicle, so that their risk exposure is also diversified in that sense?
Yeah, that's actually a good question, right? And we are always very careful with respect to communicating to customers that it should not be considered as investment advice per se. I think what's the most prudent way, and you've got other well-known fund managers who have been saying it. For example, Ray Dalio of Bridgewater saying that diversification is the one free lunch you get in investing, and leveraging diversification, being able to diversify across a wide variety of assets is clearly one thing to consider. Naturally, by nature of that, investing in ETFs, if diversification is what you're after, clearly seems to be the better way to go about it. However, if you've got strong conviction on particular investments, if you've done your own research, I think that single name stocks, of course, should also be part of your portfolio where you're ready with it. As part of Investor, we have a couple of initiatives in this. We have a daily newsletter, which is Investor Crisps, which just covers one particular company and gives you a little bit, to build this awareness on individual companies. Separate to that, you're also able to see analyst ratings that we have based on third-party research analysts and what they are, how many of them are rating a buy, sell, and hold on each and every stock. So that helps you make that decision a little bit more easily.
Right, Swastik. Right, Swastik. So, I was also reading in your report that the ticket size, the average ticket size, I know you don't believe in the law of averages, but the average ticket size for every transaction is about $800. So, that translates to upwards of what, 5,000 rupees or so. And the average assets held by an individual's AUM is in fact in excess of $5,000. That's about what, 3.5 lakh rupees. So is it fair to assume and suggest that investing outside of India is a rich man's game, and perhaps people who are new to the world of investing should possibly look at only Indian domestic markets right now? Who's the average investor who's investing abroad?
Yeah, this is the problem with averages, of course, which is so the average transaction size is $800, about 50,000 rupees, for example. But we've got a very large number, and you'll see this also in our report that almost 60% of our clients are millennials, right? And it's not necessarily a rich man's game. We've got clients who have got portfolio size of less than $100. And what really works on a platform like Investor is because you can invest in fractions of shares as well, right? So Amazon is a very expensive, it's $3,000 plus per share at the moment, 2.5 lakh rupees approximately or so on. You're able to invest in a fraction of one share of Amazon as well. So if you want to just invest $10 into Amazon, you can do that through a platform like us, and that allows you to create this diversified portfolio we're just speaking of very niftily without really needing to have a very large corpus. And that's why we've got customers who start off with small investments at $100. Once they get more comfortable, they may add on to it if that is where their you could say capacity lies. It's perfectly fine because you can still go ahead and build this well diversified portfolio without needing to break your bank.
Right. So fractional investing is something which is very interesting. And in fact, we are seeing fractional investing even in the real estate sector now, but we'll come to that perhaps on another episode of Money Masterclass. But sticking to the fact that, you're saying people are also making small investments and buying stocks fractionally. Is it cost commensurate in that sense? Because the expense ratio and the cost involved in transacting internationally are also fairly high. So in fact, there was a thread which was doing the rounds, which suggested that there are also fixed remittance costs and fixed brokerage costs. But you're suggesting that that we can actually go ahead and have a remittance cost as low as 100 rupees to 1,000 rupees, and eventually you're saying there's going to be no brokerage cost involved when we are transacting through your platform. So take us through what are the costs involved. What should one really keep in mind as a cost for investing and trading internationally?
Yeah, I think that's a very good question, and it's one which actually every investor should be aware of as well when they embark on this journey. So the costs are for remittance, so there are two parts of the cost. There's a fixed transaction fee along with with a FX spread, which is charged by your banks when you're sort of sending the money abroad. So that is a function of whichever bank you use, and that's where the cost can be as limited as small as 100 rupees fixed, or it can go a little bit above 1,000 as well. But sort of ballpark, that is where the most of the fixed costs tend to stay. The repatriation cost, for many, it's about $35 as a fixed wire transfer fee when you're wanting to return the proceeds back to India. But we have, brought that down significantly for our clients to keep it as low as $10 as well. Um, the spread is also something to be wary of. That spread can be as little as 0.25, 0.5% to about 1.5%, 2% plus as well. So if you have someone in your bank that you can speak to them, your RM or so on, if you've got one, to try to help you bring that cost down too. As a broker, we've got a zero commission plus structure. You have got a certain number of transactions free every month. You can do 3 free transactions, after which it's a flat $1 fee. In the first month, we in fact give you 10 free transactions. So that you can build up your portfolio without needing to, pay us a lot for your commissions. And then beyond that, so for over a year, you've got about 43 transactions in your first year, for example, right? We don't have any AMC charge. You don't have an annual maintenance cost. We don't have a monthly running cost of any other kind. We don't have an asset fee at all. The other part is, just on the total expense ratio, remember that the ETFs are actually much, much cheaper, right? So for example, amongst the 5 or 6 that we had, these are varying in size from 0.03%, which is what an SPY is, to about a 0.75%, which is at the highest, which are active ETFs like the ARC ETFs, right? But the triple Q is about 0.2% or so on. So really, you're not paying a lot to the fund manager. That's a lot more in terms of the outside of your brokerage account where the costs really do arise.
Right. So help us understand, break this down a little further for an investor looking at investing, let's say 10,000 rupees for about a year or so. Let's say he needs the repatriation after a year. So for an investor spending 10,000 rupees as a base calculation price, 10,000 rupees in direct stocks versus 10,000 rupees in ETF, how much of his money is actually getting invested in the stock and the ETF? And eventually when he seeks a return or a repatriation of that, how much is he getting? So, I mean, I'm trying to arrive at a figure of what kind of gains on a stock or on an index is an investor expected to see to be able to at least break even, if not make a profit.
Sure, I think that's a good question. And so we start thinking of it that, your investor is lucky. He got the 100 sort of rupees that he's sort of landed up spending. And, as a fixed cost, and say the bank's charging you 1% of that, right? So you've spent 100 rupees fixed, and then 1% of 10,000 rupees, which is about another 100 rupees, for example, right? So 200 rupees is your fixed cost that's gone out at the start. On the repatriation again, you've got 750 rupees approximately, which is the $10 fee, plus another 1% on that, right? So another 100 rupees, for example, right? So that's how much you need to at least make. You've got 200 plus 750 plus another 100, right? That you need to basically make about 1,300 rupees totally. So about a 13% return in effect is what one would be looking for a 10,000 rupee investment, right? Because these are fixed.
Got it. Right.
Right. Of course, as your size of your investment.
Yeah, understood. So if it's a large amount, obviously, since these costs are fixed and mostly not as a percentage, then you're not looking at that higher return. Got it. So,
Exactly.
So again, I think as all equity investments, the idea should be to stay invested for the long term, not look at a 1 year return. And if you have a larger corpus to invest, then these expenses and these costs sort of get amortized over time. Is that right?
Exactly. There's one other consideration also, when you're remitting money, which is called as a TCS, right, which is a tax collection at source. So the RBI, under LRS, the liberalized remittance scheme of this $250,000 per head per year, for the first 7 lakh rupees, you don't need to pay what's called as a tax collection at source. Above the 7 lakh rupees per financial year, your bank will reserve out a 5% tax collection at source, right? So if you instead, for example, make 8 lakh rupees as a total remittance, on that additional 1 lakh, you'll have about 5,000 rupees, which the bank will reserve out and deposit basically with a tax man, saying that this is tax collection, but you can reclaim it as part of your or total taxes at the end of the year, end of the financial year when you're filing taxes. So that is also just something to consider when you're making those remittances. On the other hand, the other way to look at it is at least the first 7 lakhs is completely tax free, right? For in terms of there's no tax collection at source.
Right, but then you're still eligible to pay the short-term or the long-term capital gains tax back in India. Is that right to assume?
That's right. So you will be required to pay the domestic taxes. I also want to just touch upon the overseas taxes, which is that you do not have to pay any capital gains taxes in the US because you're not a US person as it's defined who has to land up paying those. On dividends, in your US account there will be a withholding tax, which is about 25% of the dividend. But again, under double taxation avoidance agreement, you can claim that back as part of filing your taxes here.
Right. Swastik Nigam, before I let you go, just one final question. Which are the stocks in your portfolio? Which are the ones that you invested abroad in?
Oh, that's a good question. Of course, I've been investing for a very long time. I was in London, and the idea of investor came about because I had got this unmitigated access to investing, and I felt that India was missing out on it. Some of the popular stocks that a lot of people would know that are in my portfolio are like Tesla, Microsoft, Alibaba, Google, Apple as well. So I think yes, I'm sort of very heavily living that story too. But yeah. I mean, of course, I've been investing for a very long period of time, much before Investor was founded as well.
Right. Swastik Nigam, thank you so much for joining us on this very, very special Money Masterclass. I think it clears a lot of air and a lot of doubts that investors would have had transacting internationally. Well, that's a wrap on this Money Masterclass. Thank you so much for joining us on Money9. Have a wonderful weekend. Goodbye. Bye-bye.